Welcome to Trader Talk, where we dish out the latest Wall Street buzz to keep your portfolio sizzling. I'm Kenny Polcari, and I'm coming to you live from the Yahoo Finance headquarters here in the heart of New York City, a global hub where deals are made, fortunes are built, and the next market move is always just around the corner. Coming up, I'm going to share my thoughts on the value of patience. We're going to chat with my friend Keith Lerner, and we're going to share my linguine and lobster sauce recipe. It is the second dish in the Feast of the Seven Fishes for Christmas Eve. Now let's jump into the big take. Charlie Munger said it the best. The big money is not in buying and selling, but in waiting. Simple, brutal, and almost universally ignored. Most investors think that the secret to wealth is activity. More trades, more screens, more predictions. They chase the next hot stock. They jump in, they jump out of positions, and they panic every time the market sneezes. They act as if the goal is to appear busy, not to build wealth. But the truth Munger understood is this: wealth compounds in silence, not chaos. The market rewards patience in a way that it never rewards urgency. The biggest winners, Apple, Microsoft, Nvidia, Costco, they didn't turn early shareholders into millionaires because they were traded perfectly. They did it because someone had the discipline to sit through volatility, headlines, corrections, recessions, and noise. They held on while everyone else panicked. Now, waiting is not passive. It is a skill. It requires conviction, thorough research, and the strength to set aside your emotions. Real investors understand that time in the market isn't just a cliche. It is a strategy. Every day you're invested, compound interest is quietly working for you. But every time you jump in and out, you reset the clock. Here's the real Munger lesson. Most people never build significant wealth because they get bored before the payoff arrives. They sell too early, they doubt their thesis, they can't stomach the volatility, and they want fireworks, not fundamentals. But the market doesn't pay you for drama. It pays you for endurance. The bottom line? The big money goes to the investors who can sit still. If you did your homework and you believed in the business and you built a long-term thesis, then waiting is not weakness. It's your edge. Buy wisely, monitor carefully, and then, as Munger would say, sit on your ass. Okay, my next guest is Keith Lerner, Chief Investment Officer and Chief Market Strategist at Truist Financial, where he leads the firm's investment advisory group and oversees strategic and tactical asset allocation for clients nationwide. With nearly 3 decades of experience, Keith has built a reputation for cutting through market noise and delivering clear, data-driven guidance on equities, fixed income, and the global economy. He previously served as a portfolio manager at Bank of America and was a founding member of the Charles Schwab's Trading Analytics Group, bringing both fundamental and technical expertise to his work. It is a pleasure for me to have him, and please join me in welcoming Keith to the conversation. Keith, thank you so much for joining me today. I truly appreciate the time you're spending.
Yeah, Kenny, I've really been looking forward to this. I love your opening. I mean, I totally agree with the sentiment that you brought up as well. So thanks so much.
Yeah, no, listen, the truth is, I think it's true for a long-term investor. You have to learn how to be patient, right? And that's a skill because it's very easy to get emotional and it's very easy to get, tripped up by a lot of the noise. Okay, but let's start, all right? Let's start first with, we're at the end of the year in 2025. Tell me what you think were the biggest surprises for you, and then we'll look into 2026 in the growth pack, whether or not we're going to have a soft landing or a hard landing, whether you think it's going to be chaotic, at least in the first half of the year.
Yeah, well, thanks so much. And, it's one of the years, Kenny, that it's almost better that we didn't have the headlines ahead of time. Because if we had those headlines, we probably would have been out of the market almost the whole year, expecting the market to be down a lot more. In fact, I think, I can't remember who did it, but there was a study that was done on this topic where if you gave someone the Wall Street Journal headlines ahead of time, you would have actually not performed as well as you could. So it goes to your point, your big picture point of, let the market work for you. Doesn't mean sit on your hands. But as far as the biggest surprises, I would say that for the overall market, kind of the North Star of this bull market has been the resiliency of profits. So I always call, each year we have these, what I call the carousel of concerns. as one concern comes recedes, another one pops up to take its place, and we kind of flip around on that. But if you take a step back and zoom out and says, hey, what was the key driver? Why are stocks up this year? To me, it's profits. Profits are at a record high, and profit margins are at a record high, despite all the turbulence, despite the tariff uncertainty, despite the muddle through in the economy as well.
Listen, despite the sense early on, remember last January, it was all talk about we had two very solid years of performance, and everyone thought that, this third year, 2025, was going to be a year of chaos and confusion, and maybe the market was going to end a little bit lower, at least at the very best, maybe perform on average like 8 to 10%. In fact, we are double that, right? The S&P, I think, is up 17% year to date. We've got 3 weeks left in the year. The NASDAQ, once again, up in the 20% plus range. So it's been a very, very interesting year. Certainly started with the whole tariff tantrum back in April, but had you stayed on for that ride, or had you put money to work when the algos were, running for the door, you would be in a much better place today, I think, than people that panicked, right? And then tried to play catch up.
Yeah, and the other thing is, we have to remind ourselves as far as the resilience of not just corporate profits, but just of corporations in general. I mean, think about the last 5-10 years what these corporations have had to face with. You think about the pandemic. We think about the fastest rate hiking cycle that we've seen since the 80s, the highest inflation since the 70s, supply side disruptions. And what happens each time they've come in, they've adapted. And as I mentioned, that has translated into to higher profits, but also the economy, as much as, there was a lot of concerns about recessions the last couple of years, we've continued to kind of move along. So I think in the back of investors' minds, to the point you made at the beginning, is yes, we'll have downside. I mean, I always say the admission price to those longer term returns or higher longer term returns is pullbacks along the way. But I think it's just important to remember, like, our companies are battle tested, they're resilient, and they've proven themselves over and over and over again.
Right. And I think that's also key, right? Is that the companies that you're investing in, you have to do your homework. Listen, no one says it's going to be easy. You got to do your homework. You got to do your due diligence. You got to do your research. You got to understand what you're buying. And if the story remains fundamentally solid through the cycles, right? The ups and downs, if the story doesn't change, there's no reason to panic, right? I think that's one of the things that I struggle with the most when I talk to clients that are getting nervous if the market's kind of in a down cycle. They get nervous. Like, you have nothing to worry about. You own top quality names. There's no change in the fundamental story for any of these stocks. And if there were, then we'd consider moving out. But there isn't. So in fact, we'd consider buying more. All right.
Yeah,
so let's
I
look
would
at.
say just
Go ahead.
Go ahead.
No, go ahead. Go ahead.
No, I was going to say, we've done a lot of work on this too. What's interesting is the short term is the kind of the sexy part of the market, but 75% plus of returns are based on that strategic long-term outlook. And the other thing, we've done work in saying, okay, in any given year, the market is up maybe 60, 70%. When you move to 10 years, you're up 95% of the time. 20 years, you're up, well, historically, hopefully I don't jinx this, 100% of the time. So to your point, you also have to know what the money is being used for, and then you can tolerate an average drawdown each year of 14% is the average drawdown we see in any given year. So that's part of the admission price.
All right, so we're going to talk about that in a minute, because we are coming into a new year and we're coming into a midterm election year where there typically is a drawdown, at least in the early part of the year, when there's all that chaos and confusion around what's happening. Every seat is up for, every house seat is up for grabs. And so there's going to be lots of chaos and confusion. So I think that investors need to understand that 2026 could end up being kind of a volatile year, and a pullback should not be seen as panic, right? So let's talk about that. Let's talk about the growth path for 2026 and what you and what Truist is saying about a soft landing or a slowdown in the economy, in the labor market. Tell me what you think. What's the data suggesting to you?
Yeah, and what we try to do, Kenny, is unfortunately, I don't have a crystal ball, right? Everyone wants me to have a crystal ball, but what we do a really good job of is we follow what I call the weight of the evidence approach. And let me just set this up real quickly. It's a 4-bucket process. One, we start with the economy, so our economic outlook, which I'll touch on in a minute. Then we go to history and say, what have we seen history as a starting point? I think Warren Buffett said, if all you used was history, the richest people would be librarians. So you can't just stop there. And then we layer on fundamentals and then the technicals, the market signals as well. So to your question, what do we see? Let's start with the economy. Our kind of punchline into next year is we expect a modest uptick in the U.S. economy to about 2.3%. Now that's, below where we were maybe several years ago, but it's a nice uptick from the 1.8% we're expecting for 2025. And if you say, what's behind that uptick? Well, there's four main factors. One, we do think the Fed is going to continue to modestly lower rates. Two, we have some tax relief that we'll see in the first quarter for both businesses and consumers. Thirdly, we think we're going to have a little bit more stability on the tariff front. Remember, we had that shock in April. Tariffs aren't going away. There's still uncertainty with some of the Supreme Court stuff, but we're probably not going to see the same shock that we saw in April. And the last part of the component is the ongoing CapEx spending that we'll see in tech and AI. You put that all together, that suggests that we extend this cycle and we have a modest uptick in the overall economy.
Okay, so hold that thought 1 minute. We're going to take a quick break and come right back. Keith, let's talk about the Fed then in 2026, because there's lots of chatter around. There's going to be a change of leadership at the top. We know that. They've made it very clear. I suspect we're going to know before the ball drops in Times Square, we're going to know who they have picked or who Trump has picked for the new Fed chair come May of 2026, which means J.J. Powell's, will kind of be a lame duck. Right? We'll know who it is. He'll be a lame duck. And so there's a January meeting, there's a March meeting before his term ends. Tell me what you think is going to happen in terms of, I got my own sense that that the December cut is going to be the last one. January, we're not going to get one. We might get lucky if we get a March one, only because the labor market will continue to be weakening, I think. Tell me what you think.
Yeah, no, it's also going to be an interesting story to follow next year, because there's a lot of different ways this can go, and actually not just about who Trump picks, but how the market reacts, how the bond market receives it, and that could be a tail risk that we should also be thinking about. But our base case outlook is that the Fed will gradually move the Fed funds rate towards 3% by the end of the year. They do have scar tissue. Like if you're the head of the Fed, or even a central banker on the Fed, the last thing you want to be known as is the person or the team that let inflation come back again as well. So they have scar tissue. They're taking a cautious approach. And I would also say, though, from a market perspective, I would trade less Fed rate cuts with a stronger economy than an economy that needs more rate cuts as well. So I know there's a lot of focus that, hey, what the Fed does is so important for the market. It is important, but I would say those corporate profits that I spoke about earlier, what happens with AI is going to be even more important in our view.
Yeah, and I agree. And look, the AI story, in my mind, is still very much in the early innings, right? A lot of people are saying, oh, we're in a bubble. We're not in a bubble in AI, because all these companies actually produce real products, unlike the bubble we saw in the dot-com era back in 2000, right? There's nothing like that in my mind. Do I think we could have stretch valuations a little bit? Sure. But stretch valuations is very different from a bubble. Right? So could you get a pullback and a drawdown in valuations? Sure you could. And I fully expect, quite honestly, I'd love to see a drawdown a little bit, right? Let the market kind of shake it out a little bit to see who falls out of the tree. Okay, let's talk about sector leadership then next year. Where are you looking? Let's say away from AI, because everyone's going to have AI on the list. Away from that, where do you think we're going to get some leadership?
You can't take that away from me, because I'll tell you why. And we've been positive on tech all year and communication services. And I will say this, we've done a lot of work on this. Every bull market has a defining theme. And the defining thing of this bull market is still AI and tech. And we've looked back at history and says, when you have leadership in a market, does that tend to extend to the end of the bull market? And our work suggests it does. So I'll give you an example. In the 90s into 2000, the relative performance of tech peaked right around the same time as the market. In the 2000s, energy and emerging markets were the leadership to the end as well. Doesn't mean there wasn't some disruptions or some kind of sector rotation. So I think my premise would be this, Kenny, is that if you believe the bull market is still intact, then you still want to lean with some of these tech and AI side of the market. Now, we know there's huge concentration risk there. We know there's dispersion within the things like the Mag 7. We're also pairing that with things like healthcare, which has done better recently. People have gotten more excited about it.
Yeah.
But the big picture is it's underperformed by almost 50% the last 3 years. So I think there's some more runway there. And you also want to have things like small caps, even modest positions, so you don't have to try to chase these sector rotations because they're really hard to catch.
Tell me something. I'm just curious about what your opinion is. Consumer staples are completely underperforming. I think they're actually slightly negative on the year, down less than 1%, but they are negative on the year. They're not participating at all. Is that a sector in 2026 that you think is going to lift its head up, or do you think it's still going to continue to lag because the focus is going to remain on AI and everything AI?
So right now we're still underweight the group. We've been underweight the group for most of this year. I will say a couple things that we'd be watching. One, let's just say our uptick doesn't unfold in a weaker economy. That's when staples tend to shine. So that's it. I do think the point you're bringing up is an important one. They have really underperformed. The bar for positive surprises is really low. In our process, so Kenny, what we try to do, and I think you know this over time, we don't try to call tops and bottoms. What we try to do is participate in the meat of the move. So what we will be watching is for a turning relative performance and the relative earning trends. And then if we can participate in that meat of the move, great, but we're not there yet, but certainly there's a case to be made, but we're going to let the market tell us that it's turning. And right now it's just premature to say that.
Yeah, it is interesting because I too am underweight in the consumer staples sector, but it's been very interesting because like healthcare was also an underperformer all year. It was negative, mostly slightly negative, right? I mean, actually, I think at one point it was down 6 or 7%. It is now rallied significantly in the last month and a half. I think we're up 13% in healthcare just in the last, which is actually even more than that because we were down 6. So we're probably up 19%, right? Which puts us up 13% net positive. Because that was also a relative underperformance. So I'm kind of waiting for that to happen in consumer staples to see whether 2026 is a positive year for them, for the group, you know. In the meantime, let's talk about non-U.S. Where are you looking in terms of the global opportunity, whether it's developed Europe, where I like, or is it emerging markets, which I'll be honest with you, I'm not a fan of, like India, Brazil, China. I'm just not. I think there's a lot of other places to put money, but tell me what you think.
Yeah, so big picture globally, we're still Team USA. Now, Team USA has underperformed this past year, but I would say in context, that's after huge outperformance. And last year, developed international markets underperformed the U.S. by the widest margin since the 90s. So we really had this kind of mean reversion year. But when we look at earning trends, they're still stronger in the U.S. and then innovation is there as well. But that said, relative to a couple of years ago, we have a much larger allocation to international markets because 80% of global markets are in uptrends. To your point, it's Europe is close to new all-time highs. European banks are doing much better. Japan has some leadership change, and Kenny, you've been doing this a long time. We finally got to all-time highs in Japan after a multi-decade period as well. And we did break out of a multi-decade range for the EFI index. So I say, listen, we want to have exposure there.
Right.
We're not overweighting relative to the U.S., but there are things happening. And also as a hedge to that U.S. dollar, in case, what you mentioned earlier on the Fed, there's some shifts there, some more dovish folks. That would be a hedge against the U.S. dollar as well. And then lastly, to your point about EM, we are underweight there. What's notable is the biggest driver of EM as a whole is China. That's about 30%.
Right.
And the bigger driver of China tends to be tech. So you have this kind of battle with the U.S. and tech. So we're watching the emerging markets, but you're not getting the same diversification because they're kind of moving a little bit more together because of that tech trade.
Right. I always say, my exposure to China is in names like Apple, right? Because that's where I get my exposure to China. Anyway, the other thing I think is very interesting that maybe people don't recognize is if you look at developed Europe, so Spain, Italy, Germany, France, UK, those markets are all up double digits. I mean, I think Italy's up 19%, Spain's up 18%. They're up high double digits, right? High teens, which has been a very, very interesting play, I think, because they've been very, very strong, the European markets this year. And so I like Europe. I have money in Europe. I allocate to Europe, but I don't. And Japan, I think, is safe as well. I don't allocate, like I said, personally for myself to the emerging markets. I just find I have exposure to, like I said, China in names like NVIDIA and Apple and that kind of stuff, In the meantime,
I think
go ahead.
Go ahead. No, I was going to say the final thing. I mean, you talked about some tourist areas. A lot of folks that go travel into these areas as well. And then the biggest reason why international developed is actually outperforming this year is the currency. The U.S. dollar is down 10%.
Yeah.
That's really helped that overall trade.
It's really helped. Yeah, 100%. Listen, let's talk about the playbook then for 2026. Where are you thinking you need to be overweight versus underweight? I mean, I think we talked about it a little bit, but tell me broadly, and if you take the 11 S&P sectors.
Yeah, and big picture, we still have a tilt for equities relative to fixed income and cash. And then when we look at the sectors, we kind of talked about them already. It's really tech, communications, and healthcare. Those are the three today. Our tech,
That you're
our
over
sector strategy,
that you want to be overweight.
yeah, that's right. And our sector strategy is pretty tactical. So as we see those relative shifts, we will make changes. That's the area. And then as far as areas that we're more underweight at this point, we are still underweight staples, even though I agree with you, there's a potential there. So
Yeah.
we're keeping a close eye on that. The real estate side, I know they're cheap. The relative price trends are still relatively weak, and there's still these higher interest rates that's bogging that down. So that's another area that we're, at this point, still underweight as well.
Right. All right. Listen, Keith, we've run out of time on this. I want to have another conversation with you as we go through 2026. It'll be interesting to see kind of how the first half of the year plays out, because there will be a lot going on. But in the meantime, hold on, because every Christmas Eve when the house starts to buzz, and it is all about the Feast of the Seven Fishes on Christmas Eve, right? There's one dish that everyone waits for. It's my linguine with lobster sauce. Now, it's not just pasta, it's the moment. It's the moment when the pot hits the stove early on with the garlic and the onions. They start to dance in the olive oil. And then you get the lobsters that are just sitting there ready to complete the sauce. And suddenly, the kitchen smells like Christmas Eve, right? In an Italian household. It's briny, it's sweet, it's warm, it's alive. The real magic, though, begins when the live lobsters are added to the sauce. There's always that 1 second or so you see the flap of the tail. That reminds you that you're cooking something straight out of the ocean. As they simmer, the tomatoes take on a deep ocean-kissed flavor that only occurs when the shells release everything that they've got, right? Everything that they have. Now, by the time the sauce turns a rich rosy red, you can feel the waves of the Mediterranean. Look, you can scan the QR code on the screen for the full recipe, and trust me, you can thank me later. That's a wrap for today's Trader Talk, but the conversation always continues. Subscribe on Apple Podcasts, Spotify, Amazon Music, or wherever you get your podcasts. You got questions or topics you want covered? Email us at tradertalk@yahooinc.com, because we're always listening. Until the next time, stay sharp, stay disciplined, and stay in touch. Take good care.
This content was not intended to be financial advice and should not be used as a substitute for professional financial services.